Hey guys, Freaky Finance here. Last week we looked at Albertsons, a grocery chain. Today we're going to take a look at a totally different company, a totally different industry. So this is Vale, the mining play, specifically iron ore, copper, nickel. And we're going to jump into it. The chart here on their annual statements, this little map, is a little bit all over the place. Most people who are in the industry know Vale would be mainly a Brazilian iron ore play. That's how they view it. So we're going to try to dig it a little bit deeper than that and just see exactly what makes up Vale. It is primarily an iron ore play, and all the iron ore mines that they have are mostly in Brazil. They have a little partnership somewhere else, but primarily, if you're thinking about the iron ore business for Vale, it's still very much so in Brazil. Iron ore, most people would know, but it's for steel making. So remember, I want to say 2 months ago we did Tech Resources. That was steel making coal miner. So basically, when you take steel making coal and you combine it with iron ore, blast furnace, say that's basically steel. So this is just the other input on the other side. And obviously, you use steel in houses, cars, household appliances. They also do have the pellets, so that's used to be considered waste. It's actually the second biggest revenue driver aside from the primary driver, which is iron ore. And we'll break that down in a bit. Pretty interesting. And like I said already, primarily in Brazil, pretty big mine. Technically, the iron ore in this site is considered to be the highest quality in the world, though a lot of mines will make similar claims. But this one is 67%, so compared to say 62%, so it is quite high quality. This fact box, I just wanted to include this. This is also on their website, but I thought this was very funny. Well, so our mines covered as 3% of this forest area, and we are protecting the remaining 97% with their partnerships with ICM Bio and Abema. So basically, it's going to be hard to open up another mine in the area. I view that kind of as a barrier of entry almost, because they have the one mine that's been there for a long time as part of the economy now, and now they basically say this is the area that has the best iron ore, and we basically just made a huge barrier of entry from an ecology standpoint. So so it's kind of funny when you think about it from a business strategy perspective. You have the ecologists on your side, technically, which is always, I mean, that's a volatile relationship because technically they are miners, right? But they're basically saying, yeah, we'll agree not to let anybody else in, which in their case would be a competitor. So that's just how my brain twists an honest fact. Nickel is another big part of the business. Relative to iron ore, it's still small. I believe they did about 500 million in the quarter for Q2. In context, we're going to go through their financials in a second, but they did about 7.5 billion in revenue in the quarter. So about 500 million into 7.5 billion. So not a huge driver, but it is a driver. And we're going to talk about nickel again. I'm going to bring up Tesla's battery really quick here just to get people excited a little bit. But primarily right now it's still iron ore. They do have nickel, Brazil, Canada actually, quite a lot in Sudbury. I don't know if you guys have ever been there, but they have a big nickel and entry to the city. Indonesia as well. Indonesia also has a lot of iron ore mines and stuff like that. So it's not like there isn't competition in the industry. Most people know you're going to use nickel. You're going to use batteries, bathroom taps, shower heads. Copper is also fourth biggest line item on its revenue breakdown. And it's actually pretty much in line with nickel. And most people know copper has been on a tear lately. So is iron ore, actually. But the stock price doesn't seem to recognize that yet. And we're going to go into that as well. But you can see, use copper mainly for electric cables. So mainly construction play. They list all these random things down here. Plumbing pipes and doorknobs. Statue of Liberty. And again, this has copper in Brazil and Canada. So their primary mining operations are in Brazil. And they have some nickel and copper exposure in Canada. And they do have some other assets all over the place, like that first world map that I showed you had, but a lot of it is noise and kind of overwhelming. So this is the primary businesses. All right, so before we jump into the financials, I just want to show you this chart for iron ore. So traditionally, Vale's stock has kind of followed the iron ore commodity. As like I mentioned, it's the primary component of the business. So you can see it peaked pre-financial crisis. So this is going back quite some time, 2008. The low is actually the March 09 low, so much for the stock market in general. And then with the printing of money and quantitative easing and all that, you can see the reflation. And this wasn't just iron ore, there's a lot of commodities that spiked in 2011, right? Gold, for example. It's quite a few different ones. And then since then, almost like gold has been in decline and then started coming back in 2016. It's fairly volatile, the annual financials, mainly due to this cyclical nature of the iron ore business, and it's like commodity driven, just kind of like how Suncor has been. You saw the results of a low WTI in a quarter on the financials. You can see similar results here. So if underlying commodities priced high, the margins are higher for the company, so the EBITDA looks better and the free cash flow looks better. All that makes sense. So really, an investment in Vale is kind of investing in where you think iron ore is going to go. But in Vale's case, you can see that it kind of followed. So this is the stock of Vale. You can kind of see how it followed the peaks. So you had the peak in 2008, the lows in 2009, the peaks in 2011, the lows in 2016, right? And this thing can swing, right? Because it's a minor. And now it's currently at 1050. So you want to see that the basement here, you can see how the trend has come back a bit, but it's nowhere near these levels. And you can see these, especially lately, iron ore has been going up with the highest it's been in quite some time, right? However, the stock price has actually lagged and fell in certain periods. This is the COVID panic right here. You can see that all of a sudden there's a little bit of a debasement, whereas normally this would come up a bit. So far it's kind of lagged. I mean, it's not like it's worth what it is back here. That was when iron ore was at 180, but currently it's at 120. So from a commodity standpoint, based on historical trends, you'd think currently it'd be higher. That's kind of the opportunity. I also want to point out a lot of people have been looking for nickel companies. Like I said, Vale has a large nickel base of operations in Canada. And so some people say, well, Vale has a troubled past, and we're going to get into that. But from a Canadian nickel side, its Canadian operations have been in business for quite some time. I want to point out here, it may have some battery exposure, whether it's with Tesla or not. If electronic vehicles are all going to need cathodes, they're likely going to follow a similar path to what Tesla's talking about. And this is from the recent September 22nd, I think, Battery Day. It's worth your time to look through it. I know it's 3 hours, but I think it's interesting to a lot of people. At least it's interesting to me. You can see they're kind of saying for a long life cycle. So I view this kind of as their cheaper version. They didn't say that on the during the presentation, but you can see long life cycle. It's going to be mainly iron based, long range. So that's currently your S models, nickel and manganese, and then high nickel for mass sensitive. So the heavier the heavier objects, so your semis and long distance trucks, stuff like that. That's a little kicker on the nickel play. Like I said, it's not a huge part of its overall business, but it does have a lot of nickel. It's one of the biggest miners of nickel in the world, even if it is just a secondary business for the company. And one of the reasons, again, they also want to source in North America for the North America plant. Part of that is cost. Freight is very expensive for these type of heavy metals. I think heavy is for a reason, and anything heavy with freight is generally high priced. Basically, if they're building a plant, they just plot it here on their map. I don't know if they did that on purpose or not, but that's where their cathode plant's going to be, and then they're going to try to source nickel and lithium. It's funny that they have nickel and lithium down here. I mean, if I just extrapolate it down, you can see Brazil. This is totally conjecture. Then up here, Sudbury. So, I want to point out how expensive freight is for these heavy metal businesses. So, I mean, it's called heavy metal for a reason, and freight on anything heavy is quite high. So, a way to cut down costs is to try to source the cleanest amount of nickel you can in a close proximity to your factories. That's something to keep in your back of your mind. This isn't just going to be a Tesla thing. I think most companies that are going to go EV, which is all of them, are source nickel locally, wherever local is for them. So it's something to keep in your back of your head. And currently, that's not a catalyst to buy the stock, but down the road, it could be, right? It could be quite exciting. I do want to point out, before we jump into financials, their dam disaster in 2019. You're going to see this on the financials as well. So unfortunately, a dam broke, and this is on top of another dam disaster in 2015. And so there's still impairment showing up on the income statement and expenses set aside for this. There's 260 deaths after the fact. They've also, not just remuneration for everyone affected or the area, but they're also checking their other dams, which also has costs, right? We're going to go into that really briefly because it's going to show up on the annual financials right here. You can kind of see all of a sudden it's fairly green at the beginning, so that means I like it. Revenue's been growing fairly steady. You can see, more importantly, the gross margin dollar, 13 billion, 14 billion, 16 billion. So very positive trend. And you can see the SGA is actually very low for the business. I mean, after its COGS, the next biggest expense aside from impairment, is the interest expense for the debt, because it's capital intensive industry, right? I thought that was very low. Like, you have less than 500 million in SGA, but you're earning 16.3 billion in gross margin dollars. So it is a very high margin business when iron ore prices expand. I guess that's the conjecture there. They had pre-operating and operating stoppages. The event itself, so they had a $7.4 billion expense in 2019. That shows up there. They also had impairment charges of $5 billion. That shows up there. So those two items alone, that's $12.4 billion. So that's pretty much the bulk of this GMD gone in impairments. I mean, they're non-cash. Well, they're non-cash at that time. The share price has historically been higher than it is now. Like I said, it's fallen back to $10.50 or so, when technically lately for Q3 anyway, so for the July, August, and September period, we know iron ore has been trending higher, right? It's been around the 120 area for a while now. So we'll see what the average price realized is, but it should lead to we'll talk about the quarterlies in a bit, but it should lead to higher free cash flow for Q3 anyway. So if we look at the bottom line, you see there's a lot of noise there. So while it made better on GMD, it actually lost money in net income. And that's because of the dam breaking. I mean, that's a huge charge, 7.4 billion, an impairment charge of 5 billion. So not small numbers for impairments. The stock started reacting unfavorably to it, even though the commodity was starting to go up. So you can see that explains part of the divergence between iron ore prices and the stock price of the company, because it has idiosyncratic risk with its mining operations in these dams. And this is the second time, right? The dam's broken and people died. So you can see your total equity's gone down. It looks like they tried to pay down the debt to accommodate the dam liabilities. So you can see their total liabilities actually went up, but their indebtedness technically went down. It dipped back up again, so it's back up to where it was in the past. Something to keep in the back of your head. The cash flow from continuing operations, though, is actually fairly steady. So you see the noise in net income, but from a cash flow perspective, it still yielded more than $12 billion. I mean, the company is priced at $68 billion, so still trading at quite the multiple of the free cash flow, but it's not a 10x multiple or anything like that, so you're not paying crazy amounts for it, but it's probably cheaper because of this catastrophe, right? They did cut their dividends during the dam event, and they stopped their share buybacks. Their margins were expanding. That's really a function of the commodity price. Their production actually slowed down in 2019, again, due to the catastrophes. And their market cap free cash flow tends to oscillate around 8. So I did find this interesting during going through their annuals. You can see their cost structure. I wanted to just see the salary component of it. So personnel, 2 billion basically, 92 million to that, 2.1. Oh, sorry, personnel's down here, 181 to that. So that's 2.2 billion, 10% of COGS. So the personnel expense is actually fairly low. The highest expense is freight. Well, we're going to get into why, but like I said briefly, it's basically mining in Brazil iron ore, freighting it to China. I mean, that, yeah, freight is 19% of COGS, so quite high. And that's probably why Elon's trying to source locally, is freight would be a driver of cost for them as well, right? This is just some dam data. This provides some history of what happened and explains the $7.4 billion charge. If you want to, you can freeze this page just to look at it, because obviously it's a risk if this happens another time, right? I can't imagine what Brazil is going to do to this company. The quarterly financial statements also have a lot of noise. I mean, if the annuals do, these quarterlies definitely do. So it's hard to get a trend here. Like I said briefly, the revenue is largely dictated by the commodity price and the production. The production down here, you can see, has slowly started to climb back up, but it's still not what it was. And you have to remember 2019 was also low for production. Production's been slowing down. It looks like it's starting to ramp back up again. I believe the company's saying it's going to start ramping up again. And we'll have to see how that does for the commodity price, because perhaps maybe a reason why the commodity price is so low is because, so high relative to what it's been, is also the fact that the mining operations have slowed down for the company, and the company is so large that maybe it has an influence on the price, right? It is the biggest iron ore producer in the world, according to them. You can see Q2, 3.3 billion GMD versus Q2 last year, 4 billion, so slightly worse off. Again, a function of production. To realize price was also lower than last Q2, so you can see that this time it was 189. Right now we know it's trading at 120, and it's been that way for a whole quarter. So we're going to see how that looks on the revenue side in Q3, which should be pretty exciting to see how much free cash flow it can generate. They do have a steady stream of impairments, and they still have this event haunting them. So $130 or $130 million Q2 quarter, and that damn disaster is now 20 months ago. So on the call, they're trying to put it behind them, but it keeps, I guess the right word is to hunt them, keeps haunting them. Yeah. An impairment charge again is almost like a part of the business by now. Just keep seeing impairment charges, but from an operational standpoint, you're still $3.3 billion in GMD, but only incurring 125 million in SGA. So if all this noise wasn't here, which is wishful thinking, but it could happen over time, this company looks pretty attractive, right? The economics on iron ore is pretty crazy right now. And this is just iron ore at less than 90. Right now it's at 120. So it could be a free cash flow machine. And technically it still generated free cash flow, even though the quarter didn't look very good from a accounting perspective. It did start up its dividend payments again, so it's starting to have a dividend yield again. So that should attract more investors over time. It also shows that the company believes that Dorst is behind them. They're not just saying it. Puts their money where their mouth is anyway. We'll see if it's prudent or not. But right now, I think it's yielding like 6.5%. So not a small yield at all in a low return world. Obviously, that's probably a function of the commodity prices at 120 bucks, right? Versus 90. You're making all that extra margin, and that's a lot of production in tons. I do have a note down here that technically, if you were to analyze Q2 numbers, it wouldn't look very good, but that would be misleading because we know Q3 is going to be quite high, right? You got delta of $30 per ton in margin. It may also have a China versus America risk, so it also has China exposure risk. Could be a good thing if some people have a home bias, right, and they want some China exposure indirectly. China is the main buyer of Vale's goods, which is iron ore. It's also not without risk because iron has been kind of cycling high for a while now. Unlike the steel making coal video, which had Teck Resources with coal nearing the bottom of its cycle for coal, iron ore has kind of been on a tear for a while now. So it may be nearing the end of its commodity price cycle boom, whereas the Teck Resources, the steel making coal, was near the low. But we'll see what happens though if the US keeps printing money or not to bridge the income gap. I think the market might be trying to price a discount for management distrust or anyway reputation. It doesn't come back overnight, right? So, and they need to prove their infrastructure is ready so it doesn't happen again. The revenue split, just so you can, basically this is just the last quarter data. Of the 7.5 billion in sales, 4.8 billion was iron ore, and 900 million, the second biggest, was just the pellets from the iron ore. So what used to be waste, 5.7 billion of the 7.5 billion is from iron ore. So it's a huge part of the business. I know a lot of people want to focus on the nickel because it's exciting with the Tesla batteries and stuff like that, but currently it's a smaller part of the business, though it could expand, right? I mean, it is a big producer, and if the nickel producers don't step up production, you're going to have a lot of demand coming up with and not enough supply for the electronic vehicle market, if Elon's right? Which he probably is. And then you have copper, 491 billion, so slightly less than nickel. And copper, as we know in Q3, has also been on a tear with a lot of the other commodities. We'll have to see how that plays out. Again, has some China exposure. I did read an article before jumping on about gold inside of Vale, which is kind of weird. Technically, it does make money from gold, but they flag it as a byproduct, which is what it is. They're not a direct gold miner. Just when they're mining, they'll find some gold, and because it's so big, 191 million. What does seem to me new, but to a company that makes 7.5 billion in a quarter, it's very small, and that's represented here. So it's not a gold play by any means, not a precious metal play. It's an iron ore, nickel, and copper play with some other metals involved. This is China right here, this big red, 4.3 billion of their 7.5 billion, and that also helps explain why the freight was so high. Like I said, it's 20% of COGS. They're shipping goods all over the world from their mines. Their primary exposure is China. So right now we know China's handling, we believe China's handling the virus well, could lead to continued outperformance over time as China keeps accelerating, perhaps becomes the next world superpower, which is probably what demographics suggest. We'll see how the America and China tensions are going forward, and say if anything happens to Taiwan, is the world going to care enough to intervene when China eventually takes it over? Again, conjecture. But so iron ore also has superior adjusted EBITDA, so it can make, see here, iron ore 4.8 billion, and it only cost 1.7 billion in COGS. And then you had SGA 59 million, so very small relative to this, the revenues and COGS. And you can see adjusted EBITDA of 3.5 billion, 2.9 is just iron ore, right? So it's a huge component, virtually I would say 70% of the EBITDA right there, probably more. That is to say, nickel and copper do contribute as well, and so does the pellets. However, I do want to point out coal business. I mean, if you were to extrapolate Q2, you're going to say, oh, the coal business loses them $1 billion a year, so why do they have it? We'll have to see what they do with the company with coal. Unlike tech, they have both thermal and steel making coal. Thermal coal generally has less margin by quite a bit and less secure economics. That's just something to point out. All else equal, if they're trying to maximize capex dollars, they'd probably be reinvesting into the iron ore business. Well, maybe say if they think they can line up a thing with Tesla or something, they'd probably put a lot more resources into their nickel operations or look to buy another nickel company. But who knows? But right now they are making quite a lot of high margin business in the iron ore. I mean, this is before it spiked to 120, right? This is at $89 iron ore. So we'll have to see how it does in Q3. I do want to point out their reserves, so it's always something to look at, as well as their project exhaustion date, so life of the mine. So life of the mine is quite high for a lot of them. There's none that are immediate in 2020 from an iron ore perspective, as well as nickel. You can see in the 2030s, 2040s. Like I said, they did resume their dividend policy. Q3 numbers probably going to look pretty good based on the iron ore price, but we'll see what happens. Maybe they have a whole bunch of impairments again. Seems to be the trend here. I mean, they do believe the worst is behind us. They are trying to make remunerations regarding Brumadito. Yeah, that's pretty much Vale. Like I said, the main reason for looking at it is the fact that the stock price has diverged from the underlying commodity price. Maybe that's a short-term trade. Maybe it's just a Q3 trade, for example. But technically speaking, if you just see iron ore where it is, you'd almost think this would be in the $14, $16 range, somewhere in there. It's like 15 for a mean, somewhere in there. And right now it's still at 1050. I mean, that could be maybe they're just worried about this mine haunting them some more impairment charges, what have you. But technically, iron ore where it is should mean Vale's a free cash flow machine. But maybe the market's saying, well, we think iron ore is going to pull back down with the economy, right? Which is possible. So anyway, it's a commodity play. It's different than other commodities we talked about so far. But it is pretty interesting. It does have the nickel play, which could tie into electric vehicles. But primarily, right now, it's still iron ore with a tie into China, with a high tie into China. Anyway, I'd like to know your thoughts on Vale, and have a great weekend.